Howdy, Jacob here. Today we're looking at Lam Research Corporation. We've looked at this company previously in my fundamentals screener. It's company 67 of that. And there was a stock split, and I've been asked to review again based on revenue jumping up quite a bit from my initial analysis. And to just go through again, I have my numbers to the right here in white. You can't see them, obviously, that were my previous assumptions. So, and I just copied and pasted them over there. I kind of know what I did, but I didn't really look at all of them. So I'm coming in pretty dry to make some assumptions without a whole lot of knowledge of what I did last time. So let's kind of look at a very new lens if we can. So a $95 billion market cap on 93.4 billion enterprise value in the semiconductor and semiconductor equipment industry. They design, manufacture, market, and refurbish and service semiconductor processing equipment used in the fabrication of integrated circuits. The company offers Altus systems to deposit conformal films for tungsten metallization applications and some other items. Incorporated in 1980 out of California, they sell products essentially globally. And this is a humongous growth company. 5.2 billion, 5.3 billion in revenue in 2015 to almost triple that to 14.9 billion in 2024. And they actually did triple it to 2023, but there was demand loosen in 2024 as the semiconductor industry is pretty well known to be cyclical. And so you do see 14, 12, 36% revenue growth, but then you also see minus 13, minus 14 in 2019 and 2024. Two humongously positive things that I'm seeing, or I have a lot of positive things actually. So revenue growth is always good. Cyclicality of semiconductor business, I'm not really concerned about. I'm just going to be taking what has it done the last 8 years? Where do I think it's going to go in the next 7, 8 years? Base my assumption off of that. And then gross margin is going up 43% 10 years ago to 47%. Operating margin going up huge, 16.5% to 28.7%. They do pay a dividend, and in relation to their earnings, it is maybe 30%. So it's very inconsequential. They've increased it quite heavily over the last 10 years. They do have a return on invested capital that is 28% in the most recent year, averaging in the last 6 years or so above 20%. And so if they have opportunities to invest to get those types of returns, throw everything you have at that. Do not this Paying a dividend is great for companies that are in the latter part of a life where there's very little growth opportunities, and they are almost a $100 billion company. So that is a possibility. Maybe they don't have a whole lot of opportunities ahead of them, but with the opportunities that can possibly give you that type of return, I'd be investing everything I have, dollar, dime, penny, into such endeavors. 1.9 billion in R&D is over 10% of their revenue. They are looking at 10 to 15% or so of revenue as a cost of revenue in R&D. So again, that's taking money away from today to hopefully get more in the future to make your company more efficient and to hopefully hit that bottom line a lot more. Some of them are going to work, some of them aren't. So again, R&D expenses aren't all great. It can be great, but not necessarily 100% of the time. They have 5.8 billion in cash and cash equivalents. No investments as of this moment, which is interesting. 500 million short-term debt, 4.4 billion long-term debt. They have more cash equivalents than short-term and long-term debt combined. And so balance sheet looks wonderful. Absolutely no concern there. Cash flow statement shows heavy increase on the cash from operation side from a little under 800 million to over $4 billion, over $5 billion. And their capital expenditures have just about doubled. So you're seeing cash from operations well over double, maybe even 5 times, 6 times 10 years ago. And their capital expenditures is just over double. So free cash flow is immensely more positive. The use of free cash flow was in the 5 to 10 years ago a lot heavier on free investments. Recently, we're seeing just share repurchases and paying a dividend. So to me, that doesn't warrant the immense premium that a company that does reinvest of themselves with 20+% rates of return. And so when we look at the PE, price to free cash flow, it's going to be higher because I think their growth is a lot higher. I think the semiconductor industry as a whole is growing double digits over the next decade. And so I would be very surprised if they didn't have essentially that. But as for the premium, it's just going to be revenue growth and earnings growth for me. It's not necessarily going to be the the immense return that you can get from reinvesting back into yourself at those massive rates. So that's going to be enough for me to make my own assumptions. So for revenue growth, I mean, the semiconductor business growing 10 plus percent. I don't know why they can't grow 10%. For margins, I mean, their margins are growing. I love that. Maybe let's look at 28, 27. Share change, 1% for them. Let's round up is $1 billion. So $3 billion, roughly 3%, offsetting that, still 2.7 billion. I mean, maybe let's do 2.5. And then for P, price to free cash flow, I think they'll still have growth at the end of 7 years. This industry has been absolutely crazy. I think 18 seems pretty reasonable to me. And still want that 15% return. The dividend going up. I mean, that dividend of $1 billion in relation to free cash flow is not very immense. So let's just increase that with the revenue growth going up. Because I still don't like a company with the possibility to get 20% rate of return to have too much of their money guaranteed in a dividend. Because share repurchases, it's not uncommon to see share repurchases go to 0 or 0.5% or 1%. But a dividend, decreasing a dividend can be an absolutely horrendous sign, whether it is or not. Companies just don't do that. So I don't like dividend rates getting too high, especially for companies that have just massive rates of return, possibly in reinvestment capabilities. And so right now, based on these current assumptions, we're saying needs to fall 24%. Let's look at my initial assumption. So 10% revenue growth is the same. I said 25 and 24% margin. The reason I'm going a little bit higher now is because they've grown it quite heavily. And I'm looking at the end of a 7-year period. I really think at the end of 7 years, these gross margin and operating margin can definitely be 1 to 2, 3% greater than what it is today. So that's why I went a bit higher there. Minus 2%, I did 2.5, pretty close. P, I did a little bit lower. Maybe over here, I was thinking that, that return on invested capital is massive, which it is massive. But again, they've been using for the last, we're looking at the last 5 years, almost 100% of their cash flow, free cash flow, has been going to dividends and share repurchases, which is not going to give you an excessive premium on a PE, price free cash flow, in my eyes, because you're not getting that massive rate of return. Even though your return on invested capital is great, you're not reinvesting to get that rate of return. So to me, I feel pretty good about these assumptions, and 24% off. So for a company, this good. I know the semiconductor business is pretty cyclical, so maybe people aren't liking it now because that recent negative 14% revenue growth. But there's no way. I'd be very baffled. I'd be very surprised if it didn't come back, especially the semiconductor business in its whole entirety. It's just too important to the future of all of technology to not be massive. So for me, a 24% drop. Hope you enjoy the video.